their face in the market. So today my goal is to provide you with everything you need to be able to find highly profitable trading opportunities in stocks that have great potential for high profits. That's what we as a traders of course look for, with minimal risk that we have under control. I will show you 3 highly profitable trading strategies that you can follow in any market environment. This is an important thing because maybe if you already trade, you may have learned a strategy that works in a certain market environment, which then changes and stop working. And then you need to learn just another one. So what I'm going to show you here is really a different trading system that you have probably never seen before, and most people have no idea it exists. It can be easily followed and it works in any market environment. So even if you are at the very beginning, or you are not making consistent profits, or you just want to expand your portfolio with other proven strategies, I will show you how you can transform yourself into a successful investor over the next few days thanks to strategies and unusual data that most traders do not know. At the end of this workshop, you will see that trading without this information is like trading blindly, and that's what you definitely don't want. The strategies, principles and methods that I will now show you are the same ones that have brought profit of 74.43% per year per trade, and the best insiders achieved a yield of 6,205.87% in 5 years and 219.44% in 1 year. As you can see below here in these print screens, which we will look at in a moment, and I will show you exactly how it works. Over the next 60 minutes, you will learn why most people on the stock market suffer, what they are doing wrong, what I have done wrong, and what to do differently and immediately improve your results. We will look and learn 3 proven strategies that you can start practicing from tomorrow. We will spend the most time there. It is suitable for both swing, intraday traders and long-term investors. Next, we look at how out of the thousands of stocks that are available to find, only those that have high probability right now to make a big move with minimal risks. So which stocks to focus on and which ones not to focus on, so to throw away and ignore. Next, we will look at what to look out for in money management. So how to work with your capital to not put it at unnecessary risk. I will show you what I did wrong and why I lost my entire account twice in the beginning when I started trading. We'll look at how to improve your stock options profits. If you are an advanced trader, you will learn this in the 3rd strategy. And then we'll look at how to trade along with so-called smart money. What is smart money? Wall Street, which is a mecca of trading and investing, considers retail traders who are ordinary traders like us to be dumb money, and Wall Street is considered smart money. So in this workshop we will discuss how we can trade and follow smart money. Next, we will look at how you can access data that most retail traders have no idea exists and how to use it. Finally, I will answer frequently asked questions that I have collected after working with over 1,000 students. And at the end of this workshop, you will receive a trading plan from me for the 3 strategies you will learn today. It's an 11-page trading plan that shows you how to follow these 3 strategies you will learn today, and it will be the overall output you take from here. It is exactly the same trading plan that I use for trading based on these strategies that I have developed, and it is verified on real data in the real market with the real money. This is the only thing I could very easily sell for more than $500, because with this plan you will get everything you need to be able to follow these proven strategies. So at the end of this workshop I will send you a link where you can download this plan for free. Let's talk about who this workshop is for. It's for traders who fail to make consistent bigger profits or make money, or you are just starting out and want to go straight on the right path. So if you spend whole days in front of the charts, you tried several times and you still do not get the results you would like, or you consistently lose money, or you still stand in the same place in the circle in which I was in the beginning as well, this workshop will show you how you can trade less and earn more by learning proven strategies and focusing on unusual data that will give you a big competitive advantage over other regular traders who, on the other hand, consume the same information and do not see this key data. Further, if you have a day job, you do not see a shift to the future, or you simply want to earn extra money and you are attracted to investing and trading stocks, this workshop will show you how you can make more money by trading stocks than you have ever thought would be possible, because your money can make more than you. And of course, if you are a student, if you go to high school or you are thinking about going into the business, start trading and making profits, then this workshop will show you how to avoid the fate of your peers. As Warren Buffett once said, the only thing I regret is that I didn't start investing until I was 13 years old. Until then, I wasted a lot of time. So Warren Buffett, of course, is one of the richest people on this planet, who is known for investing in companies, buying stocks, actually started investing very early. But of course, if you are older, it doesn't matter, because you can do it at any age. For example, my grandfather started trading stocks in his 80s, so it's never too late to start. Of course, this workshop is also for entrepreneurs and business owners. So for those of you who do business and make profits, that you want to fire value and spend only interest on that invested money. And in fact, such a basic rule is never spend your earned money. You need to save, put aside, employ them, because money earns more than we do, and then spend the money that made the money, not us. So if you want to get into a position where you don't have to be dependent only on running your business, but you have more sources of income, which has always been my goal, then this workshop will show you an investment system that is not time consuming and you can follow it when you run your business. Alright, so let's move on to the first basic rule. Big movements don't come on the big well-known stocks and stock indices that most people trade. Maybe now you often hear differently on YouTube and elsewhere, buy the index, watch what Google does, what Amazon does, what Coca-Cola does, and buy these quality companies. Most of these companies already have a relatively large market capital. They are simply too big to grow in any way. And most importantly, most people know them. This means that very rarely will a situation arise where such a company is undervalued in relation to the true value it has. Yeah, so here you can see, for example, the Coca-Cola chart, which de facto here, even after the rising that came during the COVID pandemic in 2020, where the price is traded somewhere, if you take this level, somewhere around $40. So it actually took 2 years before the stock price reached 60. That means if you buy one share for 40, good, you have a $60 in 2 years. So you earn 20 per share, which isn't exactly a place that can move you forward somehow faster. If you want to achieve above average valuations, then you need to focus on a small and medium-sized companies which have most of the growth ahead of them, and most traders overlook and do not follow them. The media do not talk about them. They go completely beyond the horizon of most people. For example, you can see the SM Energy stock here. I will get to it in a moment, but you can see that this stock traded for $2 in 2020. Yeah, maybe it went even lower, but if we take $2 practically 2 years after that, or a year after that, we can say that it was traded here, we have 2021, it was traded here for as little as $26 per share. That is, it's more than a tenfold appreciation, and here it even got to $41 out of $2. So this is of course the place that will move you far faster than if you stay in a segment where most people who come to trade stocks are. In the US market alone, around 6,000 types of stocks or companies are traded, and the key is of course to find those that have the potential for the next big move with as little risk as possible. And at the end of today's workshop, I will show you how you can find these yourself in a few minutes. So this workshop will really teach you how to fish yourself when you will be able to look for these situations. This interesting graph here, because you can see here that only 25% of the shares are worth all the gains, while 75% of the shares together have an appreciation of 0%. If we make the overall index, then some of the shares simply fall, some go up for a long time, some grow a little, but in effect the whole, about 6,000 companies, 75% has an appreciation of 0%, and only 25% are behind all the profits. So what we want is to focus on this group of stocks and the others cut off completely. As investor Peter Lynch, who was known for being able to catch so-called multi-baggers, multiples of the investment when he bought the shares and once multiplied, said, if the stock does not have the potential to appreciate 3x, 5x or 10x, then don't even show it to me. This brings us to the basic rule of money management. When trading stocks, I always want to have more potential for appreciation than my risk. Here you can see in this table that if you have a risk-reward ratio, here you see a risk and here reward. This is an example. I risk $1,000, I go for 1,000. The risk-reward ratio is 1 to 1. The same cost of risk, the same potential for reward. This is, you need to be at zero here. Break even means to be at zero, not to lose on that investment. You must have a 50% success rate to be at zero. Once you go into the negative, you can see that you need to be successful. That means that if your risk is 5,000 and you only go for 1,000, then you need to have an 83% success rate to be at zero. You will not earn anything. You will be at zero. If on the other hand we go 1 to 2, that is, I will risk 1,000 but I am going for 2,000, all of a sudden I only need a 33% chance of not losing money and I will be positive. So as soon as I have risk-reward ratio of 1 to 2 and I have 50% success rate, I am already a very profitable trader, and yet I can hardly miss half of the trades and make money on them. So this is an important rule. You will see as we go through those investors and strategies that this is where we aim for more potential for appreciation than our risk in the trade. The second rule is for beginners, if you are starting out, not to risk more than 2% of the capital in one trade. Remember, 2%. Of course, as soon as you improve and you are more confident in what you are doing, you can raise this percentage. Warren Buffett, for example, is known for having 100% of his account at the beginning of his career. So once you are more and more confident, you can raise that percentage. But in the beginning, people make really big mistake by getting excited about something and putting 100% of capital into it. And it won't work out. Possibly even on some leverage instruments, and then of course it's a big disaster. So this is what will keep you in the business for a long time, and yet it can make you a lot of money. Of course, as I talked about the need to focus on the lesser-known stocks, on those that are smaller, they are smaller, medium-sized companies. So of course, if you get a valid signal, which I will show you in a moment, on a big blue-chip stock, it is possible to trade. But I myself use stock options, which will give me more potential for appreciation with a fixed risk, even if I do not use stop loss. Stop loss is if you don't know the level you set in the chart for the stock where you stop your losses. For example, if you enter for $100 per share, you put a break in 80, so you set a so-called stop loss. So if the stock price goes against you, it will kick you off here and you have the risk under control. So with those stock options, you will see in a moment that you don't need to use it to keep that risk under control. You will learn about this in the third strategy in this workshop. Here you can see an example of LIT, which is a trade I took myself where those options has increased tenfold. So you can see here the ETF on LIT, on Lithium, where here on this date, June 16, here we have June, that means 16, half, it's somewhere here. That means in this area, the stock price was some, let's say, $67, $70 roughly, and that price, you can see that it broke to a new high here and reach $81. So you say, wonderful move. If you buy stocks, you will earn about $10. You enter for 70 and it gets to 80, you are plus $10 per share. But if you bought one option, it cost $80 at that time, and we bought it, you see here 0.80, you pay $80 for one option. The option is traded here at these levels and you can sell it for $900. So the appreciation with those options here has reached more than tenfold, and that's what we are going to discuss in the third strategy. So even if you start with small capital, you can start using these strategies thanks to fractional stocks. You don't need hundreds of thousands or millions to trade this. Of course, if so, there are no limits at all. And thanks to compound interest, you can easily get from $5,000 to more than $52,000 in 5 years in a systematic and verified way. Here are some examples of compound interest, where as soon as you give it more time, then of course comes the magic that Albert Einstein called the eighth wonder of the world. Compound interest is where you make money not only from your own money, but also from that interest, which you earn another month, another year, another quarter, and so on. And then it multiplies much, much faster. So this is an example of what an account would look like at 50% account appreciation per year. You may be wondering, if you are a long-term investor, that's a lot. Yes, yet Warren Buffett said he was confident that if he traded in a small capital, which is in the order of several $million, he's able and guarantees to make a 50% appreciation. And he did this in the beginning. He did much more practically in a few years. Then as soon as you have a more capital in the order of hundreds of millions of dollars and billions of dollars, the range of opportunities you can take decreases and shrinks, so that the percentage appreciation is much worse. So with a small capital, we are in heaven. We have many more opportunities. And if you are trading right now, or you are interested in short-term trading, speculation for example, then it may seem like little to you. And that's right. For example, I had my best period when I was able to increase my account by more than 200% in half a year. Is it realistic that it will continue like this still forever? Of course not. There will always be some fluctuation, but this is an example that with a 50% appreciation, you will receive $52,000 from the start of $5,000. And if we extend that time, let's see what it will do with that compound interest rate. If we double the time from 5 years to 10 years and keep doing the same thing, suddenly you are not double or triple, but you are 10 times. You are at the 555,995. So if you are really starting out, there's no need to worry about having less capital. I started with an account of $500. This was my first account with which I started trading. And this is my favorite quote for Warren Buffett. The market is a place where money moves from the impatient to the patient. So who the hell is Dominic Kovarik and why should I listen to him? Maybe you're thinking now. So this is me, Dominic Kovarik. I have been trading in the stock market since 2008. I started small. My first capital was only $500. I turned it into $10,000 and then I lost everything in 2 days. I didn't use money management. I didn't use the rules when I had the risk under control. I didn't have 2% in the trade. I had 100% in the trade. Leverage. I like to trade gold, so I made a lot of money on gold and then I returned them all there, and then I finally switched to stocks and options. I now invest and trade in stocks of more than $1 million of my own money. I focus on the US market and I consistently manage to beat the market. If you are in some of my live rooms, you can openly see my accounts there. I started sharing my trades and knowledge with others, and I enjoy it. Being part of a group and sharing knowledge reduces the loneliness one sometimes feels in trading. After finding out people I work with and train have success, I decided to give even more to the public. Hence, I have founded a startup and founded it through my investments. We hired 2 specialists in their fields like software engineers, big data analysis, and others, and we have success. We grow and grow. As of today, we have 2 teams residing in 2 locations. One located in Switzerland, the leader in banking and financial innovation, and the second in the Czech Republic, the very heart of Europe. We have developed profitable yet simple strategies everyone can make use of right now. I always pass these strategies on to a small group of people who work with me. And you will learn our 3 flagship strategies for free today. In addition to stocks, I also invest in real estate. I recently bought this apartment building with my business partner, which we are reconstructing into flats, including a fast food restaurant downstairs. So not only am I in stocks, but I also invest my earned money and money in real estate. I became a father recently. This is my son Albert, to whom I will of course also want to pass on all the information I will teach you in this workshop. This is me at the investor conference, and this is my trading room, my office, where I trade and spend the most time. So let's dive into it. Why do most traders lose money in the beginning? Because they are fighting in the toughest field with the equipment everyone has. This Apple chart, which is a stock you probably all know as well as everyone else because it's talked about a lot. It's well known, it's a great company. So you jump on Apple. For example, Apple here, on that chart you can see that it created a so-called price support where somewhere around $157 per share. We can say as a traders, not investors, that we are now trading the next bounce from this level where it comes. So in fact, if we enter somewhere here in this zone, we place the stop loss, which means preventing those further losses, just below the support, usually where most of the traders really place it. And of course, professionals and trading algorithms know where the stop losses are, which is actually the liquidity. And the market always moves where it causes as much pain as possible to as many people as possible. So they actually send the price against those retail traders. It sweeps out the tracks, ordinary traders are out of the trade. Consequently, the price is free to move up, but without you. Just think or tell me how many of you have experienced this. I don't know about you, but this has happened to me many times. So as I said, it is professionals who publish articles, manipulate prices in the short term, and often send prices against retailers to move their money together. So the typical way of a trader seems to be that a trader reads the newsletter, comes across an article from some outsider, which is usually an editor, blogger, YouTuber, in short a person who is not inside the company, does not build the company, does not have internal or inside information. And this man will tell him that there is a great stock here and he will like it and buy it right away. A slightly more advanced trader will look at a chart to see if there is a trend channel, support, technical analysis, which he probably learned somewhere on TikTok or somewhere on social networks and is used by everyone, and everyone's look at it with the same eyes. And precisely because they all consume the same information, read the same articles, use the same technical analysis, they cannot gain any advantage on their part and lose money. On the contrary, in order to be able to make money consistently, you practically only if you think about it logically, you need to do the exact opposite. You need a proven procedure and information, unusual data that most people do not see and are not publicly available. Because that's what gives you that advantage over other traders and investors. And that brings us to a system I call shameless cloning. Let's embark on 3 strategies that are based on the so-called shameless cloning, which any of you can follow and brings great results. Now let's figure out in a logical way who can have the best information about a company and have already found out with a great certainty that a company is severely undervalued and thus has a great potential for subsequent growth. Will it be an editor from a newsletter? Will it be a blogger? Will it be YouTuber? Will it be someone on a social networks, on a Facebook and Instagram? It won't. So the first ones are the so-called insiders. As Peter Lynch said, there are hundreds of reasons why insiders sell, but only one reason they buy, because they logically want to value their money. I would add that there are two reasons why they buy, because if it's a bad company, then the man from the inside, the insider, I will say exactly who he is in a moment, can come and buy the company's share in order to impress the investors outside and convince them that, for example, in a company that is bad, nothing happens and they can keep their shares in peace. So this is our first strategy, cloning the most profitable insiders. The keyword is most profitable, because not everyone is profitable. I will talk about it later. So let's just say now who the insiders are. They are so-called insiders. They are the company's top employees, including executives, directors, and managers. These people work 24 hours a day, 7 days a week on their company strategy and finances. So they know their company better than anyone else, better than any YouTuber, blogger, editor who publishes articles. Because this person lives in that company, goes there every day and works on those strategies every day. They have the best information about what is happening in the company, plans, and what its real value is. They are called insiders because they own inside information about the company, while others are called outsiders. In short, we are everyone else who does not work and build in that company. And like you and me, insiders can buy shares in their company, provided that they are required by law to report their share purchases and sales to the Securities and Exchange Commission within 2 days. Otherwise, they risk imprisonment and a fine of up to $5 million. So they have a lot of reason to do it, and they really do, and it works great. On average, there are 28 insider purchases every day, which is quite a large number, and shopping for the best insiders is such a great informative signal. So let's take a look at the examples. We don't have to go that far. Let's take a look at Elon Musk, who is the CEO, the owner of Tesla, whom you definitely know. Between 2014 and 2019, which we will see in the chart for a while, Tesla was in such a side market and the company was losing money. However, Elon Musk expected a large improvement in free cash flow based on several factors that the average trader had no idea about and ignored. During this time, Elon Musk bought shares in his Tesla company for more than $100 million. I will show you exactly those purchases. And the deal was reported to the Securities and Exchange Commission. The market was wrong. The average trader had no idea what was going on in the background, and Elon was right and valued his investment by more than 1,000% in 1 year. Then he had a good reason to dance like a superstar on stage. Investors who followed this insider trade made a fortune. So investing can be very difficult when you are an outsider, which is most people. Unfortunately, investors often buy and sell bad companies because they either do not have the right information or are misinformed by other outsiders who listen. So here we can see Elon Musk's purchases in 2011, 12 and 13. Here you see Tesla's chart 2011, here we have 2012, here we have 2013. So in 2011 he started to build a position where he bought shares in the amount of $40.72 million. Then came 2012 where he bought for only $1 million, and still the stock more or less went to the right and not many people believed it. 2013 came when Elon bought just $100 million, and it was May 29th. So you see May here, which is May, and he was shopping somewhere in this zone, and then this move came after he built this position. And the stock, which was somewhere around $5, after those splits, of course there were several splits, when the stock is so-called split, when it becomes expensive so that it becomes cheaper. So those prices could have been different in history. They could be different now in those splits. So it was around $5 and fired at $50. You see, it reached almost 60 sometime in 2014. So more than tenfold appreciation on this investment. Of course, he didn't just stay with when he shopped in 2011, 12 and 13, but you can see that after some time in 2018, May 6, he made more purchases. In 2019, he made another purchases, and on February 13, 2020, he made another purchase of 10 million. 25 million, 10, 6, 18 and almost 10. Here, just take it. If you look at the chart I had approached on the previous slide, it was this one, an area where the rise is practically invisible, and yet it was more than a tenfold rise here. So then the stock slept again for a long time. It went up and down here, simply to the right. And in 2018, he started shopping here again. In 2019, it went down, buying more and more for another $25 million. And then in 2020, he added another $10 million here. When the stock went on sale, what the price did? It exploded and soared to levels of $1,200 per share. So again, he was actually able to accumulate positions again after all the splits. When the stock was around $50, here was $100 at the drop in 2020, so the price then soared to more than $1,000 per share. So for Elon Musk again, more than a tenfold increase in his investments in his own company, in which he works and spends every day and thinks every minute about how to improve Tesla. Coincidence? Looks like no, because he was very, very knowledgeable. But the great news is that it's not just Elon Musk, but exactly 62,518 other insiders who can buy their own shares in the companies they build. And again, the most interesting insiders trades come again at laser-known stocks that fly out of the ordinary retail traders. And now we can look at these other examples. So here is an example of Paul Rusnak building Sonic Automotive. Here you can see this chart here. By the way, he is a man who emigrated from Czechoslovakia to the United States to California, where he sells luxury cars to Hollywood stars and very wealthy group of people. So he spends most of his time at Sonic Automotive again, and logically he has the best information that no YouTuber, no outsider out there you may be listening to has. Here we can see the year 2009 when the price of Sonic Automotive dropped somewhere to $1 to $2, and here we can see the purchases of 2009 around $1.18, $2, and then movement followed in 6 months, because we only have the year 2008, so here in about half a year, the stock shoot from $2 to almost $14. So you can see again a very decent appreciation in very short time. Then he made more purchases. You see 2010, 2011 again. And here we can see on the graph when we postpone it, here on the bottom two, where we have the year 2010. This was the one 2009, which was followed by this hill up. So after 2010, the company actually got into some side markets again, started consolidating here at the support. And the Paul Rusnak comes in with more orders and buys and adds so much more. $3.5 million, $3 million, and then $1 million in 2011. See what happens to that company. It fires, and in 2013-14 trades for almost $30 for some $27 per share. His purchases were around 10. So here again, we have more than doubled the value of those other purchases. Of course, these ones made the evaluation even more interesting than before. Because if you consider that he bought the stock for $1 or $2 and got to $27, it's again more than 10 times the value of this investment. You can see here for this insider that his success in time, the length of holding these trades is 100%. So if you follow the trades and transaction of this insider, then your success rate in this time horizon would be 100%. You would never lose money. Again, you may ask if this is a coincidence. In short, they are the people who have the best information about the company and can rate it far better than anyone out there. We can look at another example here from Sales Lawrence, which is an insider from S&P. Here you can see that he bought his company's shares again in 2008, then 2010, several purchases, then 2012, more purchases. We can see that he bought shares for $2, $7, $7.90, then for $13, and $12. Although it wasn't quite a big volume, look at how well informed the purchase and the signal actually was. Here we can see 2012 when the stock fell from some to $20, $25 to almost $10, $12, $13 where he bought. And look what followed from 2012, the 6th month, to 2013, the 6th month. That is exactly 1 year. The stock went from some $10 to almost $40 to $35. So here we have a triple appreciation of his investment in 1 year. And we can move on here to Welsh James, who is the manager for more titles for more companies. It often happens that insiders may be a member of a board of directors or may act there as a consultant or 10% shareholder, who is also required to report those transactions in more than one company. So you can see here that he is involved in the title Yale, SNDR, and SKYW. So here you see again a few purchases in 2012, 18, and then 20. When we can describe here in this example at Yale, when he buys shares for $560, 2,000 shares. And we can look again at what happened after that purchase. Here you can see the purchase in 2012 for $560. We have $5 down here, so $560 here somewhere. The stock continues sleeping in the side market for a few months and then firing to the moon at the 35 out of 5. So here in this case there will be an evaluation some 7x, 7 times in 1 year. Here we can see the 9th month of 2012. Here we have the 6th month of 2013. Here's the 8th month of 2013. So it wasn't even 1 year when you would achieve a 7-fold appreciation here. If you do this purchase again as an informative signal towards the long run. So we can also look here at SKYW, which he bought on March 13, 2020, which was actually exactly when the economy closed due to COVID, buying 1,000 shares for $26.50, and we can look at the development here. You can see the big sales here. From some $65, it dropped to somewhere around $10. He bought for $26. That is, here is where he bought. And then it took almost a year for the stock to return to $60. So more than double the appreciation. Let's take a look at the unusual insider buys of APPN, who began aggressively buying on May 3rd, 2022 for $2.36 million until May 9th, 2022 for $17.32 million. This is again a tested insider which has a long-term success rate of 96.83% in its trades. Here you can see sentiment in the last 3 months where you can see significant purchases that outweighed sales. And the price on May 10 surged by more than 35%. That's 1 day since the last purchase of the investor where he bought this stock for $17.32 million. On May 10, news was released that Appian had won a lawsuit and won $2.036 billion from its competition. The insiders apparently knew the verdict before and were already in a position to do so. Remember that there is first price, then news. Traders who bought after the report missed the whole move. Nevertheless, many beginning traders think that they will gain some advantage over other traders by reading the news. In this real example, you can see that insiders not only position themselves in the long term, but also speculate in the short term and have great information. And in this way, of course, we can go on and on because, as I said, we have about 62,000 of those insiders here. So a really large number. But let's look at another option. Who else can have the best information about a company and has already found before us that a company is severely undervalued and thus has a great potential for a future growth? Those insiders, we have come there, you see, in a logical way, which of course makes a lot of sense, and you see that people simply know what they are doing. And you have seen the hills that follow their purchases from the best. But who else can it be? They are analysts. They are Wall Street analysts, and that brings us to the second strategy, which is to clone the best Wall Street analysts and specifically their recommendations. So let's take another look at who Wall Street analysts are. They are the largest banks and institutions on the planet that you probably know, but you may not have known or do not know that they are doing what we will show in a moment, and we can benefit from that. So there are companies and institutions such as JP Morgan, Morgan Stanley, Credit Suisse, Barclays, Wells Fargo, UBS, Deutsche Bank, and others. You can see that they are very rich companies. You only see the buildings they own. And each of these companies has dozens of employees who are focused on a narrow segment of the companies they analyze. They calculate estimated prices and give their clients recommendations for buying and selling on individual shares. So practically every day from morning to evening in these buildings, people work on one single thing, and that is to evaluate companies correctly. So they don't do anything else. They simply lie in the company's reports, they study them, they communicate with the management of those companies, with the directors, the managers, and they find out and estimate how much the company should be valued at. They have the latest technology and employ some of the smartest people on the planet. So let's take another look at the examples and how you can turn this into a second strategy, cloning the best analysts. Their recommendations from Wall Street. Let's look at examples. Let's take a look at the OCX stock here. Again, you can see it's, I think, for most of you, shares unknown. It's not Apple or Google. As I said, on these shares, it is very difficult to happen that these known shares will be traded in some way with a big discount on that fair value, because most people know it. As soon as you practically say, I know the company, it's a warning sign that you will rarely be able to buy a very undervalued company. So the OCX traded on July 30, 2020 for $1.42 per share when an analytical recommendation was received from a verified institution for purchase. Again, the important word here is to clone the best analysts. So we tested analysts, and of course, not everyone is profitable and has good, consistent results. It is necessary to take this recommendation only from the best, which we will get to in a moment. But here you can see on this board, it's great out here because the deal has already taken place, but on July 30, 2020 at 10:10 we received a recommendation with an estimated price of $6 when the stock traded for $1.42. And this analyst, who spends most of his time working and studying the company, estimated that the value of the stock is $6. So you see that the action is buy. Recommendation has come and sees the potential at about 370%. Here you can see the point where the analytical recommendation came. July 30, 2020, the price traded somewhere around 1.42 at this level. And then followed this hill where actually in half a year. Here we have the year 2021, January. Here we have March. So in half a year, where did the price go? At $6. It even reached somewhere up to $6.50. Here is the estimated price, and that price reached $6 in 6 months. So we have some 5-fold appreciation, 4-fold appreciation, something similar in 6 months based on this recommendation from the analyst. And if we held this investment for exactly 1 year and didn't turn it off somewhere earlier, it always cost $6 here. So exactly a year later, the stock traded for $4.79 and still bought an appreciation of some 201%. Here you can see that this analyst has a success rate of almost 66%, which is very decent. And the yield on that one recommendation in 1 year averaged 31%. So let's look at another example, SM Energy. As you recall, at the beginning of the workshop, where I showed you an example of that Coca-Cola and then SM, it was no coincidence that I found a chart that flew up and put a print screen there, but here again came a recommendation from one of top analysts from Wall Street to SM when the stock traded at $1.78 on November 3rd, 2020, when a recommendation came from a verified institution to buy. SM, you can see here the exact hour and minute the recommendation came when he further increases the price from $5 to $7. He gives the recommendation to buy, and we can look at what happened again on the chart. Here's exactly the date, November 2020, when the price is trading somewhere around $1.80, and look at what happened here, even in the long term. Here we have the beginning of 2022. Here is the beginning of 2021. This is the period after 1 year. After 1 year, the stock is from $1.80 to $38. So it exceeded that $7 expectation. But even so, if you held that stock from $2 only to that $7, which happened there de facto in 2 months, it's still a very decent appreciation. When something appreciates from $2 to $7 in 2 months, it's very good. And again, if you held the trade here for exactly 1 year, would mean a yield of 1,095.78%. Again, this is an analytical company that has a success rate of around 63% and a yield of almost 45% per referral per year. So you can see that their success rate is a bit lower than that of the company before, but that profitability is almost 45% per year per recommendation on average, which is very decent. So here we can look at a more well-known stock, Nvidia, which you will probably all know. It was traded on September 15, 2021 for $121.87 per share when an analytical recommendation from a verified institution was again purchased. And here we have September 15, 2020 came the recommendation and price estimate of $700 with a recommendation buy. This is the area of September 15, 2020 when this recommendation regarding the price of 121.87 cents came. That price went right for a while, consolidated here. You can see that it swept a lot of stop losses. So as I talked about the example of Apple, where in the short term the market makers trading algorithms, we do not want to play this game with them because we have to give the stock a little space. So it certainly shook a lot of traders out of it and then run away again. So we have this informed purchase here, a recommendation from an analyst, and the price then increased subsequently. You see the year 2021, this is November, so by the end of 2021, it had reached somewhere around $340. So if you follow a very simple principle that you don't specify, I will catch the peaks because it's obviously very difficult. So if we follow the simple principle of I will turn it off in a year, then actually September 15, 2021, exactly a year later, the stock is trading at $219 and it's a yield of almost 80%. So still a very decent appreciation if you take it compared to stock indices. So of course we can continue with these examples because there are a large number of analytical companies and it is done non-stop and we receive analytical recommendations for various stocks every day. But let's now think about what other data will alert us to the big players positioning in stocks and speculating on another big move. So we have already discussed the first strategy, which were insiders. These are people who work non-stop in that company and have great information. The second strategy is analysts, the best analysts on Wall Street. And what can the third strategy be? I talked about it at the beginning. They are options, and specifically unusual options activity. So this is our third strategy, cloning the most unusual options purchases. So let's just get started for those of you who are starting out, so you may not know what options are. It's for more advanced traders. There is no need to bother with it completely. If at this moment you only want to use the first and second strategy, you can without any problems. You don't have to go into options at all. But it is something more advanced and short-term traders will find a great advantage here as well, but also long-term. So what exactly are options? Options are financial derivatives that are linked to underlying assets or shares. They have their own stock exchange. They are call and put options. If we buy a call option, we speculate that the stock will go up. I make money when the stock price goes up. If I buy a put option, I speculate on a drop in the share price. That is, I make money when the stock price goes down. One option, because it is a leverage product, controls 100 shares. That's why we can use the capital more effectively. As you could see in that example, LIT, where one option costs 80 cents, but because it's a leverage product, one option controls 100 shares. So we always pay times 100. i.e. we will pay $80 for that option. And that trade behaves as if we owned 100 shares. Either we buy 100 shares or we buy one option. That's what makes it really fun. But by just buying the option, we are not going to embark on any more advanced spread strategies. Now we are still just buying, so I can't really lose more than I pay for the option. So I pay $80 for that option, and even if the stock goes bankrupt, it goes to zero and declares bankruptcy. So without using a stop loss, I can only lose $80. And I have the leverage in hand. That is, if it go up, then it doesn't multiply as much as in shares, i.e. I buy for $10, it gets to 20, so I have doubled, but I buy for $10, and if the stocks gets to $20, I can have 10 times those options. Far more because I have the leverage there. In addition, each option has an expiration date, so it actually has an exact date when the contract expires. And in fact, this, in a logical way only, gives us what? The notion of time, of what the investor thinks about the future development of the share price until a certain time. So if we have a date now, let's say it's on December 30, so if we see someone buying a call option, we know he is speculating upwards with expiration with the date the contract expires, let's say January 31st, which is my son's date of birth. So here's 1 month when that option ceases to exist. And what does it mean? How can we use this information? He buys a call option, speculates on a rise. We look at the volume, evaluate that this is an unusual purchase, i.e. there is someone who suspects something because there he puts a lot of money into it. And we know that the contract will expire on January 31st. i.e. it is a person who is waiting to move upwards within 1 month. So it's actually a great indicator for better input timing. So here those expirations can be expirations when the contract expires the next day, the third day. So this is a great use by intraday traders. This can be an expiration date of 3 months. So again, swing traders can use it. And it can be an expiration that expires in 200 or 600 days in 2 years as a longer-term investors. And we can use it as a longer-term investors, this information. So this is the third way, cloning the most unusual options purchases. So let's take a look at the example of Spider Trade, where we can see the intraday situation where shopping came here after Spider. Spider, who you don't know, is the ETF, which represents S&P 500, the largest stocks index. Here we can see the spider on the 5-minute chart. So one candle lasts 5 minutes. Here the price came down, and look at what happened here at this level around $430. Call option purchases started coming here to 430.18, 42.95, 431.57, 432.06, 433.14, and $433.14. See what time it was. There was almost always buying. From $430 first, we had 431 here, and then 432, etc. And that price got here from that level to $434 per share. Look, just for the sake of interest, what kind of strikes, which is. I don't want to bother you at all, but you can still choose strikes for that options. I.e., if I buy a stock and go to the trade here, I actually buy that stock for $430 per share. Anything upstairs is a plus to me, and anything downstairs is a minus to me. The share price is $430, but because the option is a derivative, it is only tied to the share price, so it has its own stock exchange, so I can buy a strike such as $434, which is so-called OTM. It is out of the money. It is out of the money from the price. It's far from the money where it is. So you can actually see that all these traders are buying these OTM options here. 430, 32, 32, 430, 31, 33, 34. I mean, this one tells me the second thing. If I see someone buying at a spot price, i.e. at the price of $430 per share, the stock buys at 432 or 434 strike. So he speculates on a big move, because in order to make some decent money on it, he needs the move to come and come right away. And that expiration, it was here on July 6th, and expiration on July 7th, actually immediately the next day. So this is a great indicator for intraday traders. And the price flies upwards. Actually almost immediately. Actually that day, because that's a 5-minute chart. And here the spider then opened at a $434 per share with gap up the next day. What I would add is that you can actually take this third strategy where you monitor the unusual option activity as informed signals, indicators for entries, but you do not necessarily have to buy options. You can stay on the stock in peace, see that someone is buying those options there, but instead of options, buy the stock and ride with it. So if you are starting out, it will be more understandable for you. So let's take a look now at the earnings trade on Netflix. Earnings is the day the company announces its quarterly results. Here you can see that we have seen unusual purchases, this time put options. So when someone buys a put option, they speculate on a decline. Here came 3 unusual orders just before the market closed and the results announced. They bought a strike 307 at a spot share price of 350. The next day, the stock fell to $225 and then gradually continued to $175 per share. There is always someone who knows something, and here we can watch them nicely in real time. Just imagine someone putting just 513k in decline before the results are announced in contracts that expire in 3 days. Definitely have a quality information. By the way, these options more than doubled the next day. So this man turned $500,000 to more than $1 million overnight. So you can see that you can use this information for both sides, long and short. You can make money even if the market is falling. Let's take a look at another short swing trade, where we recorded unusual purchases of put options on Upstart on November 19, 2022, when the stock traded between $216 and $17, and someone bought options with a strike of $200 and $210, for a total of $4 million with expiration January 21st, 22. Since these unusual put options purchases, the stock price has dropped to $92 per share. This is a 60% decrease from this signal within 2 months. In this case, the options almost tripled. So the investor turned $4 million to about $12 million. And the advantage is that we can ride with these big investors and just put, for example, $1,000 into this trade and turn it with them to $3,000. So you can do the same even if you have significantly smaller trading account. So here we can look at a swing trade on Facebook where we can see again call options March 15, 22. You see here in yellow, this is a trade over $1 million, 4:41 p.m. at the spot, $189, someone buys a strike 200. So OTM out of the money again. So we have 2 months of time for this contract to expire. And someone is buying these call options here for $11.5 million. A very unusual purchase. Someone put $11.5 million into call options that expire in 2 months and speculates upwards. Again, will it be someone passing by, someone outside who has no idea what he is doing and just throws 11 mil there? It won't. Here we can see what happened on Facebook during these purchases. Here we are March 15. Here we have March, so half right here at this point. That spot was 189. Here we have 185, here we have 190. 185 is right here in these places, in this area. Investors are starting to buy call options in the volumes of several million and tens of millions of dollars. See what follows next in a few days. So on the 1st, 2nd, 3rd, 4th, 5th, 6th, 7th, 8th, 9th, 10th day, in 10 days, we are priced at $230 per share out of $190. It's also a very nice move on stocks, but of course options, because they are a leverage product, so they multiply far, far more here. So what you need to be able to start using these strategies successfully? What you need is a mobile phone or laptop or computer, the internet, a broker's account, in short, being able to enter those trades. It's probably not necessary to have a real account right away if you are just starting out. It's good to try it on demo, on some simulator that I can point you to where you start trying. Of course, if you already have an account, you are fully equipped, nothing is needed. What you need is to have strategies that once we have been through, you already have. The money management under control, not putting 100% of that capital into that one trade, because it's possible that it may not work out. So I want to survive and not to take the opportunity to trade another such great signal again. So I'm only giving a certain part to it, as we went through at the beginning. And of course, I need to have verified unusual data that will alert you in a real time that the conditions for the strategies we have now discussed are met. So for those unusual data for these strategies, you will need to test all the insiders, which is exactly 62,518 insiders, and evaluate their trading results, because not all insiders are profitable. Because insiders are consistently making new trades, there is a need to consistently test them in a real time and recalculate their performance. Because some may get worse, so they drop out, but new great ones may appear, and some, those who did business between 2008 and 2015, may suddenly find a situation where these insiders buy again. And if we have tested that these were the people who made a lot of money and are now shopping again, for example after 5-10 years, then it is usually the best informed buying signal. Then you need to keep track of new informed purchases from the best in real time and receive alerts so you don't have to manually go through the hundreds of thousands of new data that is constantly coming in. Because only purchases, only buys come in 28 a day. And the same needs to be done with Wall Street analysts. Test them, keep testing them, because they keep sending new recommendations, so we still have to test them to see if they are still good, and create a leaderboard of the best. And once you have that leaderboard, track them and track their new ratings in real time and get notifications. For an unusual options activity, you have to keep track of all the options that are traded on the stock exchange. These are the millions of options a day that go through the stock exchange and people buy and sell them. And select only the most unusual in a real time, with a big volume where people buy for several $million or it's the OTM strikes, and the other parameters that it must meet according to the specific settings of the algorithm that selects it in real time, and get notification about them again. Virtually none of the above is in the power of humans, not even hundreds of perhaps thousands if they work hard on it every day. So now you have two options. The first option is to keep sleeping in the same place, to be in the same circle, to keep losing money, to read the same news as everyone, to use the same technical analysis as everyone uses, and to think that they will give you an advantage. Wait to hear from some YouTuber, editor for another hot tip, which will hopefully come out this time, and lose 3 to 10 years maybe more of your life by looking for more information. And you probably never get to consistently profitable trading that you will be in control of. Or learn these proven systems and strategies from someone who has been trading since 2008, but more importantly, gain access to validated unusual data in real time so you know as soon as the conditions of these strategies that you have learned are met. That means the most profitable insiders are buying, the best Wall Street analysts are giving you recommendations, and the biggest investors are buying options. Have this tool available to you that will search for and monitor the best trade opportunities 24/7. So I'm introducing you to TradeStreet, an online application we have built with my trading partner and multiple member team of programmers that monitors and reports unusual verified data for traders and investors in real time. Plus training a course that will teach you to trade and use this data effectively, even if you are a complete beginner and know nothing about it. So what you have learned here is still in this course, where you will have access to all those videos, discussed in even more detail. So let's take a look at what it looks like inside. So this is what a TradeStreet application looks like. Now we are inside it and we are here on the Insider tab. The app runs on the web or on a mobile phone, so there is no need to install any software, nothing like that. So let's go to the Insiders tab. Here you can see above, overall we measure sentiment. That is, we measure all insider purchases, buys and sells. In general, the market is dominated by more sales than buys. But you can see that even this sentiment, an indicator when the period comes when more purchases than sales, is a very good indicator for the market in general, towards the long run. Here we can see the situation in 2017 when you see the overall purchases from all insiders significantly exceeded sales of insiders. Quite a big difference. $42 billion in buys versus $3.9 billion in sales. So just looking at the 2017, the spider, the S&P 500, you can see the price go up. And then we can of course see a great situation here, April 13, 2020. What is the date? When the COVID was here. And after the market plummeted Most people did what? They panicked. Maybe you remember what you did. If you traded, you, I don't know, sold stocks, you were scared, you find out, you probably went to consume the public media and find out what those bloggers and YouTubers tell us. What should we do? Meanwhile, you consume this, insiders buying stocks, hard, and these purchases overweight those sales. Specifically, on April 13, 2020 alone, the purchases were recorded went through year for 2.6 billion versus sales of 1.5 billion. So a great indicator for a strong buy. We can see here 2020, this is the COVID, the rains, the April that followed. And the insiders were right again. Then you can see the black on the right where we are watching the sentiment for the last year. Here we monitor specific months, so 0 to 3 months, total sales were buying 3 to 6 months, 6 to 9 months, 9 to 12 months. So we can see overall whether it is being bought or sold. This I will show you in a moment. It also works on your watch list. Which you can create here if you say, well, I'm interested in a stock here, SAH, so I will put it in a watch list, and then you will measure that sentiment only on that watch list, which I will show you in a moment. It has also great power. Here then, if we go to the second box, here you can see the most profitable insiders by yield in 1 year. So our algorithm actually tests the insiders in this group if we hold this investment for no more than 1 year. So you can see here our order, which we have created here, and of course, there are a lot of names. Here you can see their income. Their earnings, how much they would make money, and it's tested on market data, because it often happens that, for example, the insider gets the share at a price that the ordinary investors are not able to buy. So the data is usable for me and for you. Here we look at James Welch, who we had in that presentation. One of those successful insiders, you can actually click to his transactions and wait. The system keeps an eye on him, waiting for him to make a new transaction. I will show you in a moment what a new transaction looks like. So you can see here that Welch James is actually an insider for titles SKYWSNDRYELLSPR. For more stocks, if you copy trades from this insider and open the position for 1 year, then 100% of the transaction would be profitable with an average return of 129.9% on a single transaction. That means that this insider never lost money on any of his transactions during this period. Here you can see that we can monitor the profitability in 5 years. So what would it look like if you kept those trades for 5 years? If you copied trades for 5 years again, then 100% of transactions would be profitable with an average return of 179.8% per transaction. Here you can see that these last two trades from 2020, 2018 have not expired for 5 years, so we still register them here as open. As soon as they take place, they close, so here the market return, the percentage appreciation, and here you can see the past ones. So here you click it like this and see where he bought it. Again, a coincidence that he would accidentally catch the bottom, purchase here for 860. You see here under trend 860 purchase, shot at $25 per share. In a very short time. So this way you can click through the best insiders here. So here in this box on the right you can see the latest purchases from top insiders according to the yield for 1 year.
I'm home now. Andy, I know you're saying live, but like I told him, I think it's great. I knew Karen was in town.
According to this ranking. We are consistently updating this ranking as
What do you want?
Take your clothes off. Floor's apprentice, I can do that.
You have experience?
Fix your toilet.
Shut the handle. Well, here's a good one. Reset the coffee.
we test the insiders, how they enter the trades, whether they are
Smart, we're grabbing dinner tomorrow night. You should join us.